Good morning. I'm Gord Long with the Financial Repression Authority. I have Ronald-Peter Stöferle joining us this morning from Vienna. Ronnie is a noted Austrian economist and money manager with Incrementum based in Liechtenstein. Welcome back, Ronnie.
Good morning, God. Good to see you.
Ronnie, though you've been on before, a lot of our listeners may not be familiar with your background, that of Incrementum, or in fact where Liechtenstein is. Could you help us with that?
Liechtenstein is in the center of Europe, next to Switzerland, Germany, and Austria. It's a great place to do business. It's one of 5 nations worldwide that doesn't have any debt. So I really enjoy doing business there. Regarding my background, I used to work for a big Austrian bank, Erste Group. I started writing about gold, the so-called In Gold We Trust report. In 2006, I made some very bold forecasts. Back in the days, I said that gold will rise to 2,300 US dollars. And yeah, when I started really reading about gold, I'm reading about our monetary history. I somehow found out about the Austrian School of Economics. That is not taught at all in Austria, unfortunately. So I read a brilliant comment by Ludwig von Mises, and then, just thought, okay, Google Austrian School of Economics, and that basically changed my world. I read dozens of books within the next few months, and after a few years, I said I really want to set up my own company together with partners from Switzerland. And we founded Incrementum in 2013 in Liechtenstein. And yeah, we're really proud that we're practitioners of the Austrian School of Economics, what we call Austrian investing. And based on that, we are running a couple of funds.
Ronnie, I have the picture of the cover of your book that's now available for pre-ordering at least, and ordering very soon at Amazon. I also have up a list of the table of contents of the book. Could you tell us why or what prompted you to actually write the book?
Well, I have to admit, I'm not an economist, and this is probably the reason why I'm pretty open when it comes to the Austrian School of Economics. After a few years working at the bank, I really found out that those very complex econometric models that try to forecast the future and future prices, that they don't work, especially in times of crises like 2008. All those very complex, sophisticated models that were done by, I don't know, rocket scientists, whatever, really smart people, that just didn't work. So the Austrian School of Economics, if you want to describe it in 2 words, I think it's common sense. Unfortunately, common sense is not very common these days. And as my friend John Butler just told me, you could also call the Austrian school the no free lunch school of economics. So as I really tried to find out more about Austrian investing, I found out that there are only very limited resources when it comes to that. And of course, I read Mark Spitznagel's book. Mark Spitznagel was the partner of Nassim Taleb. Then I read Mark Skousen's book, Viennese Walls Down on Wall Street. And I found out that we've got different views, different ways how to implement our Austrian views. And then we said, okay, we got to write a book. And as you know, my In Gold We Trust reports, they tend to be quite longish. So the last one was 140 pages. So it didn't take us too long to write the book. It was published in German last year. It's quite a bestseller, I would say, in the German-speaking world. I mean, it didn't sell as many copies like, I don't know, Harry Potter or 50 Shades of Grey, but for investment book, it sold pretty well. We were nominated for the German Finance Book Award. So we said we gotta translate it into English. And our dear friend Heinz Blasnik, who is running the blog actingman.com, Also a great Austrian economist, a practitioner, a great writer. He translated the book, and yeah, we're really proud that it's now finally out.
Ronnie, what was the key message that you wanted to lay out in writing the book?
First of all, I would say, as a practitioner, of course, we are writing about the theory of the Austrian School of Economics, but this book is really dedicated to practitioners of the Austrian School. What we want to point out, first and foremost, that the Austrian School has a completely different view when it comes to inflation, the definition of inflation, but also the consequences of inflation, and regarding our monetary system. If you talk to a Keynesian economist or a monetarist, I mean, for them, there's no point about discussing inflation. For them, inflation just means rising prices. For an Austrian economist, inflation, it means just increasing the money supply. Rising prices are just a consequence. The Austrian school really addresses things like the so-called Cantillon effect, that increasing the money supply is not neutral, like the monetarists would see it. So I think for the investor, it's really crucial to understand that we're not in a cyclical crisis, but in a systemic crisis. And the Austrian School of Economics really shows that the new monetary system that started in August 1971, when Richard Nixon temporarily suspended the convertibility of the dollar into gold, that since then, yeah, of course, we're seeing major misallocations of capital. We're seeing boom and bust cycles. We're seeing more and more monetary, but also political interventions. And this clearly shows that we're in a systemic crisis, and that the solutions of monetarists or Keynesian are absolutely wrong. And I think this is really a major point that we are making. And for us in our investment process, this interplay between inflation and deflation is really crucial to understand. This what we call monetary tectonics, this pressure that is building up underneath a kind of calm surface. So this is a major point. We are also, of course, talking about some sort of a philosophical portfolio. We are writing about financial repression, your topic. We are writing about general rules of a portfolio. We are writing about entrepreneurship. Mises once called the entrepreneur or the businessman the historian of the future. And then we're talking about practical things, where to look at if you want to learn more about the Austrian school, what to invest to make some sort of a anti-fragile portfolio. And yeah, that's basically it. We've got 364 pages, so I think it's a great read for the Christmas holidays.
What is it that people that are not familiar with the Austrian School of Economics
Yeah.
really need to know about this form of economic thinking?
First of all, I think it's important to say that if you've got some sort of an Austrian mindset, you're having a great advantage. Of course, you know about the monetary system, you know about the interplay between inflation and deflation. It is not spread among investors, so perhaps you've got some sort of a contrarian bias. You're able to understand alternative currencies like gold. You're thinking outside the fiat money system. You're understanding as an investor that you always have to focus on the real performance that you're making, not only the nominal performance. And I think one crucial point to understand is the Austrian business cycle theory. And this Austrian business cycle theory has great advantages when it comes to tactical asset allocation. On the other hand, we also have to say that when you've got an Austrian mindset as an investor, that doesn't mean necessarily that you will be a highly successful investor or hedge fund manager, whatever. Because Austrian investors tend to be very sensitive to flaws in the capital structure. So they tend to have a very bearish bias. So many believed in 2008, 2009 that hyperinflation is around the corner. Many thought that shorting stocks is the best way to go. Perhaps many of us underestimated the power of politicians and central banks. Then you tend to have extreme portfolios, so the risk allocation might be a problem. If you're an Austrian, I think you're probably more likely to like and understand gold, but also silver. But if you're having this mindset since 2011, you just got big minus in your portfolio. So I think the risk allocation problem is also one that we wanted to stress. Austrians tend to be very convinced, so there's perhaps some sort of a dogmatic bias. And first and foremost, the Austrian school doesn't make any timing calls. So the Austrian school says we can observe and diagnose that there's major misallocations of capital happening, but due to this collective corruption, how Professor Pollard calls it, it's in the interest of most of the people and organizations that this system just holds up. So you should not underestimate this power. And therefore, the Austrian school doesn't make any timing calls. And if you observe, for example, that there is something in the subprime market in the US going on in 2004, 2005, if you would already have shortened the subprime builders, the lenders, Fannie Mae, Freddie Mac, and so on, 2005, 2006, you probably would have gone bust before finally they would have gone bust. So you really have to be cautious when it comes to timing. And this is what we implemented in our investment process. We said, okay, we've got this Austrian view, but you also have to be very, very careful when it comes to timing.
Your inflation signal indicator, which is proprietary and available on a subscription service, is very, very critical in determining a lot of your investment decisions. Could you explain it to us?
So the incrementum inflation signal basically just shows us in which direction is inflation going. And by inflation, I don't mean monetary inflation or asset price inflation, it's price inflation. So from an Austrian point of view, first there's monetary inflation, then there's asset price inflation that we are seeing big time at the moment. And the next third stage, perhaps the final stage, is price inflation, consumer price inflation. This is what central bankers focus on, of course. So for us, we said, what are we good at? Where do we feel best investing in? We said, okay, it's precious metals, it's mining equities, it's oil and gas, and the whole commodity complex. Then we were sitting down for quite a few months and said, okay, what is most inflation sensitive? And it's exactly those asset classes. So for them, a change in inflation rates is the crucial driver for prices, rising or falling. And then we said, okay, it's not the absolute level of inflation that counts, it's just the direction. And this is something that we really point out all the time. If inflation is at 10% and it's coming down to 5%, people would say, okay, that's still pretty high, 5% price inflation. However, this is disinflation, and this is a negative environment for gold and mining equities, for example. However, and we have seen it in the 70s, 1974 till 1976, we have seen a major disinflation. When we see rising inflation rates, that's the time when you want to be long mining equities, energy, commodities, and so on. Since 2011, we had falling inflation rates. remember that late summer 2011, inflation rates in the US on a year-on-year basis were 4.5%, which is quite a lot. Since then, we have seen disinflation, falling inflation rates. And this has also been quite a negative environment for gold and mining equities, of course. Now, what we're seeing going forward is, first of all, when you want to be bullish on mining equities and oil, you're basically investing alongside central bankers. You're in the same boat like central bankers, which is kind of weird. But central bankers are doing everything to achieve higher inflation rates, to see rising inflation. So, and this is also what a gold and mining investor wants at the moment. So, from my point of view, I think 2016 might be some sort of a turning point. Just due to the base effect, we will see rising inflation rates going forward. I think, for example, in the Eurozone, Signore Draghi is very successful with trashing our currency, unfortunately. So I think rising inflation rates will become a topic, and the Fed and central banks will, as always, be massively behind the curve. That makes me very confident that we are on the right path. On the other hand, this is for investors. This is some sort of a pain trade for a typical balanced portfolio, because when we're seeing rising inflation rates, not only fixed income performs poorly, but also equities. So it really depends on the sector in equities that you're investing in. Not every company has got great pricing power. You really have to differentiate. So rising inflation is the pain trade for every investor nowadays. For our investment approach, that makes me very confident. At the moment, our investment signal says neutral inflation. It might switch to rising inflation rates soon, and that's what we, of course, will also publish to our investors and subscribers.
There are three cycles: the business cycle, the credit cycle, and the Federal Reserve's rate cycle. They're all tied together. It's my opinion, personally, that the credit cycle has changed. Do you want to comment on that in regards to the importance of the Austrian business cycle that's laid out in the current Fed policies?
First of all, I think this will be the shortest and the shallowest rate hike cycle in the history of the Federal Reserve. I think that they will hike in December. If they wouldn't, I think the market would completely lose trust in the Federal Reserve. I think Janet Yellen is perceived not to be as strong, especially when it comes to communication, as Ben Bernanke. So if she would refuse to hike now, it would be a complete disaster for the credibility of central bankers. However, I think following, not, GDP numbers are always backwards looking. If you have a look at purchasing managers index, PMIs, the ISM, of course, if you're having a look at the numbers that the companies announced for third quarter, I think we might be in a recession in 2016. I mean, that's not our base case, but I think I definitely cannot rule out a recession in the US going forward. But of course, for an Austrian, a recession is something just normal. It's a bit like a fitness program. Yeah? It just prepares the economy for the next stage up. There's entrepreneurs, there's investors that didn't do a good job, will just be sorted out in a recession. Yeah, companies that are financed not so well will just go bust. It's just a very normal process. However, trying to avoid such a recession, whatever it takes, with QE, with fiscal stimulus, with monetary stimulus and low interest rates, will make the problems even larger. I think the Fed is very concerned about the economy at the moment, and therefore I think that after perhaps one or two rate increases, they probably will have to take them back. I think that negative rates in the US might be implemented. That's of course what quite a lot of academic studies just suggested in times of crisis. And they say that the evidence from Europe is extremely positive, that negative rates obviously work. Of course, if you have got an Austrian mindset, it's a disaster. It's just monetary voodoo. But still, I think that the Fed might be thinking about implementing negative rates. And that's in fact what Kocherlakota already said mentioned at the last dot plots from the FOMC board. So this might happen, of course, QE4, something like that. On the other hand, marginal utility, something really big in the Austrian school, is just falling. So therefore, the next round of QE has to be bigger than the last one, not only 80 or 85 billion per month. It would have to be 120, 150 billion per month just to show any effect. And I think that we will see increasingly fiscal stimulus. Very important or interesting to see is that what used to be called helicopter money, and this was mentioned for the first time by Friedman, and then mentioned again by Bernanke in 2002. There's many voices saying that we should introduce some sort of helicopter money, but it's not called helicopter money anymore. It's called people's QE. And of course, people's QE doesn't sound that brilliant. So I think this might happen 2016. Expect much more interventions fiscally and monetary. So on the other hand, I don't think that the business cycle, I think that the credit cycle and monetary supply leads the business cycle and are created, creating the business cycle. And therefore, I think the Fed will have a hard time really fighting this falling trend in economic activity.
Ronnie, in your book, you have a whole section dedicated to the Austrian School of Practice of Investment. What are the key takeaways from that section?
I think one of them is, first of all, to have really some sort of a anti-fragile portfolio. So you really want to decorrelate your investments. Then, of course, I think investing in your own skill set offers a great yield. Just attending seminars, reading, writing, and so build up your own opinion. That's crucial for every investor. I think a good investor differentiates from bad ones in times of crisis. That's what Nassim Taleb said, actually. Become an entrepreneur. The Austrian school really writes about entrepreneurship quite a lot. In fact, it says the only long-term path to high return consists of sustainable capital accumulation through entrepreneurship. And I think what is crucial today is that the Austrians are very modest. They're saying we cannot foresee the future, but get ready for all possible scenarios. Diversify. And I think that's a short wrap up. Of course, we have written 330 or 360 pages about our views. I think it's really a valuable read. And some people reading the German version said it's quite a philosophical book, and it's not like a book where we are recommending, do this, do that. No, we really want to cultivate and establish this Austrian School of Investing. And I hope that we succeeded. I hope that the book will at least be as successful in the English speaking world, like in the German speaking world.
Your book lays out a lot of your thinking in the Austrian school. Your paper that you put out every year, In Gold We Trust, which is very extensive, talks further. But you also have some great information on your website. Could you tell our listeners how they could find that website and learn more about that information?
Yeah, of course. On our webpage, we've got yeah, a huge part about the Austrian School of Economics, about the history of the Austrian school, how to differentiate, what are the major points of the Austrian school and the Austrian investment philosophy. Of course, we are writing about Liechtenstein and why we are in Liechtenstein. We've got an advisory board featuring Jim Rickards, for example, where we discuss markets, but not only markets, but also political events, social events. We're discussing it on a quarterly basis. Then you've got interviews and the newest articles on our webpage. So I think it's a great source for every Austrian-minded investor.
Ronnie, it's been an absolute pleasure having you on the show. We'll have to have you back, and all the best of the season and a Merry Christmas. Thank you.
Thank you very much, and Merry Christmas.